Hello, good afternoon, everyone. I am Astha from Prudent Wellness team, and I thank you all for joining us again for a very useful and informative session on tax regime. As per the budget and announcement for this year, there has been changes made in the new tax regime. Today's session will help us understand the old versus new tax regime and the impact of other tax proposals in the annual budget. To understand these details in a much better way, we have invited on our panel Mr. Saurabh. He's the founder of Magnum Finvest Services and alumnus of IBS and St. Xavier's College, Calcutta. He's a qualified MBA and CFA. He's having a decade experience in managing corporate treasuries of banks and financial institutions. He is also currently a visiting faculty in many MBA institutions such as ICFI, business schools, BIBS, and IEM. So I welcome Mr. Saurabh. A very good afternoon to you. Over to you now.
Thanks, Dr. Astha. Thank you, entire Prudent team, and thank you all friends for turning out in such big numbers. We all know, most of you, in fact, I'm also very curious to learn about taxation, tax planning, the new tax regime, the old tax regime, because again, a lot of confusion also prevailed whenever government comes up with some of the changes. So let's understand and let's identify, okay, in terms of the tax regime, in terms of the taxation structure, whether you want to be in the old tax regime, new tax regime, how exactly we wanted to structure. So let's figure it out and let's move accordingly.
Yeah.
Great. So again, friends, when you talk about financial planning, I would, or you talk about tax planning, first message which I wanted to sincerely, communicate to you is that your tax planning and financial planning is not two different buckets. They are a part of the same bucket. When you do financial planning, to please incorporate tax planning at the time of choosing the right product, because if you have done that, probably not only you will save tax, but also you will enhance your overall return on your portfolio. This should be the objective of today's session, not just to understand the old versus new, but also to understand the products that fits in to your tax bucket, as well as they give you the overall, I would say, comfort in terms of the way you do your financial planning. So the way you can realign, I think probably that would be the best way. Concentrate, and I would rather say let's participate in the discussion so that it really becomes very, very meaningful, and let's learn. Because again, a lot of new things are coming out, circulars are coming out. We also getting a lot of clarity in the budget. Before I move ahead, I just want to draw one simple basic salary structure. Okay, this is nothing specific to any company. It is a very generic structure where you have different components, such as you have your basic salary, you have your allowances, you have your HRA, and other allowances could be petrol, entertainment, and then you get a component of gross salary. From there, provident fund gets debited from your salary, and finally you get a component which is called net salary, which is called CTC. Okay, so this is the total cost to the company from the taxation perspective. In this slide, I just wanted to ask one question from all of you. How many of you are staying with your parents, let's say with your in-laws, or you are staying in a house which is owned by your spouse, parents, in-laws, and you are not claiming HRA? Okay, so you are staying in a house which is owned by, let's say, your parents, either by in-laws, or let's say by your spouse, or let's say by any of your relatives. You are staying with them and you are not claiming HRA. So it's true for how many? You can just type in the Q&A box itself that, okay, maybe yes, no, you are not claiming. So it's true for how many of you? It's really very important before we move ahead. Okay, we got our first responses. What about others? So all of you are claiming HRA, even though you are staying in a house which is owned by your parents, okay, or by your in-laws, or let's say by you're staying in anybody else. Perfect, great. Yes, Satya, this is what I'm going to talk about. Just take 2 minutes. It's really very interesting. Some of you are claiming, some of you are not claiming. So, okay, the responses are pouring. I think it's almost a mixed response where 30–40% I could see people are not claiming HRA. I think this would be the biggest takeaway for all of you in today's session, that even though you stay in a house which is owned by your parents or by your in-laws, or let's say any of your relatives, you can still pay rent to them. As simple as that. you can pay rent to them. Very simple. You need to prepare a normal rent agreement, just that you would have done with a normal landlord. You need to prepare the rent receipt, and you need to transfer money from your account, let's say, to your nominees, to your tenant's account. The tenant could be your, parents' father. Now you identify, let's say if the house is in a joint name, if it's owned by your mother and your father both, your mother doesn't have any income. Okay, better you pay rent to her because house is in a joint name. Whatever rent you pay to her will be a tax-free income for her. Okay, let's say if you are in 30% tax bracket, your spouse or let's say your father is in 30% tax bracket, it doesn't make sense to pay rent to them. Okay, because you will not be taxed, but they will be taxed 30%. But let's say if your mother, or let's say if in case of a person, if your spouse is in a tax bracket which is lower or doesn't have any tax bracket, you can do that. How to get the optimum number, we'll come to that later. We have a slide for that. But the best thing is that, please ensure that you claim HRA. You can pay rent to your husband, you can pay rent to your auntie, uncle, anybody, you can pay rent. Income tax has never said that you can't pay rent to your relatives. Okay, you can pay rent very, very comfortably. And you can save decent amount of taxes, friends. Okay, assuming let's say if your HRA is 2 lakh rupees, you can save 30% tax. 60,000 you are actually, you can save tax. Even though if it's a joint property between your father, uncle, your father is a owner of it, his name is there, you can pay rent to your father. It's not required that you pay rent to your uncle also, you can pay rent to one person also. This is the beauty of this act, so please ensure that you utilize it. And for all those who are not claiming HRA just because your landlord, or let's say you're staying in a PG and that person is not giving you any, I would say, rent receipt, etc., still up to 8,000 rupees per month, 1 lakh rupees per annum, you can claim HRA. For that, you don't have to disclose any documents. Sometimes your company may ask for the document because you don't have it, no problem. While you file your income tax return, at that point of time, you can claim it. I think we have reached the maximum limit of 3,000, and we are not able to accommodate, other audience. That's the message it is continuously pouring in. So really sorry. Maybe we'll try and organize one more session for maybe some of your friends who have not been able to join. So coming back to the HRA, so even you have, let's say, as I am saying that you can't, which I was talking about, even for a minimum 8,000 rupees you can pay rent. Okay, you can pay a minimum rent of 8,000 rupees per month up to 1 lakh rupees, and you can save taxes on that. Very, very simple, very important. Please at least save tax on this element. That is really very, very important for all of you. Another important question which I wanted to ask. Process is very simple, friends. If you would have stayed in a rented house, you have to furnish the rent receipt, you have to furnish the rent agreement to the company, and you have to transfer the money from your account to that account. That is very simple. That process you can simply Google, or you can simply check with your HR what is the process of claiming HRA. They'll tell you. Okay, let's understand some of the hacks where you can save taxes. Let's do that. Okay, I think that's a much more I would say better way to take it up. I'm really sorry you might be getting a lot of these pop-ups. In fact, I'm also getting all these pop-ups that webinar is full. So next, another very important question I wanted to ask from all of you. In your salary slip, there is a component of provident fund. Okay, that employee provident fund, let's say, you guys, company deducts from your salary and pay to your EPF organization. Company also contributes some portion from their side also, and they also, and both the club together, they pay to the government authority, EPFO department. Your ATC, where you get exemption of your employee provident fund, does it include both employer or employee contribution? Okay, your ATC includes both employer plus employee, or it is only employee? Okay, your ATC, does it include employer contribution, employee contribution, or both? Okay, what does that ATC will reflect. Come on, let me just go to the Q&A box again and let me find out. Hold on, the answers. Only employee contribution. Okay, only employee contribution. Most of you are claiming only employee. Some people are saying both. Some people are saying both employer and employee. Again, please don't do that mistake. I've shown you this example of CTC. In your CTC, friends, only your contribution is there, not the employer contribution. Please have a look at it. Only your contribution is there, not the employer contribution in the CTC. Okay. So please ensure that only your contribution gets included, not the employer contribution when you contribute to ATC. ATC, we all know when you invest in products in section under section ATC, a lot of products are there for which you get tax exemption. Okay, so your EPF, which is contributed by you, only that gets included. The other, element, other component doesn't get included. So please ensure that only while computing your ATC requirement, that how much you have to save other than your EPF, please ensure that you take only your contribution, not the employer contribution. That is really very, very important for you to understand. Okay, that's really important for most of us to understand. So these are the two big, I would say, takeaways and some mistake typically we do while in the way we wanted to understand our tax planning structure. Next, moving on to the difference between the old and the new tax regime. So old tax regime, you all know it will be there. First of all, some of you might have questioned whether the old will be there or not. Friends, old will be there. Okay, government has used one term that it's a default or something like that. So old will be there. Okay. So old will be there, new will be there. You just need to decide whichever tax regime you have to be into, whether you want to be into old, whether you want to be into new tax regime, you guys have to decide. Okay. So please ensure that you choose it very, very thoroughly. And this is what we'll discuss right now. In the old tax regime, most of you are aware that up to 2.5 lakhs nil taxation, 2.5 if your income crosses 5 lakh, then 2.5 to 5 you have to pay 5%, 5 to 10 20%, 10 and above you have to pay 30%. And in the old tax regime you can get all those exemptions, whether it is ATC, whether it is ATD, whether it is HRA, all those exemptions, whether it is your NPS, education loan, interest on education loan, buying an electric vehicle, all those exemptions you will be able to get in the old tax regime. But in the new tax regime, situation is different. Okay, you don't get benefits of all these exemptions. Okay, you don't get benefits of all these exemptions. However, the slab limit is very, very wide. So typically, if you are earning less than 7 lakh rupees, you don't have to pay any tax. Simple, open and shut case. So all of you whose salary is CTC is less than 7 lakhs or up to 7 lakhs, you don't have to pay any taxes. The moment it crosses 7 lakhs, you have to follow this parameters: 3 to 6, 5%, 6 to 9, 15%, sorry, 6 to 9, 10%, and 9 to 12, 15%, and let's say your 12 to 15, 20%, anything above 15 is 30%. Okay, that is what something you need to follow while you are understanding, analyzing your requirement or your eligibility in the new tax regime. Okay, so now friends, what you have to do, you have to compare which one would be better for you, whether you want to stay in the old one, whether you want to stay in the new one. These calculators are available in income tax portal. Many a times you guys are really confused what to do, how should I pick it up, and all those things. So don't really get confused. These details are available in income tax portal, and you can very, very comfortably get all these details from there. No issues at all. You can just put your salary structure out there, your form 16, etc. You will be able to get the difference. So idea is to understand and analyze. So what is the difference? If prima facie, if I look between the old and the new one, definitely the new looks much attractive, because up to 7 lakhs I don't have to pay any tax. Even my income process beyond 7 lakhs, 9 to 10. Just look at this comparative slide. Okay, in this between 5 to 10 you have to pay 20%, and in the new tax regime, once you process beyond 12 lakh you have to pay 20%, and 30 is above 10, here 30 is above 15. Okay, so Again, once you look at the entire structure, the biggest catch is that in the old tax regime, you get all the exemptions. In the new tax regime, you get only 2 exemptions. One is standard deduction 50,000. This is a new introduction. Till last year, standard deduction was only eligible for the old employees who are following the old tax regime. But this time, standard deduction is available for all the employees who are also following the new tax regime. So virtually, if you would see, if you are earning 7.5 lakh rupees, you don't have to pay any taxes, because 50,000 is the standard deduction which eventually you will get. Okay, and then only another second exemption which you will be able to get is NPS only, which is getting debited by your company and it directly goes to the EPFO department. I'll come to that NPS, but before that, we all should know that you are contributing to NPS via 2 methods. First is self-contribution. You can log into NPS portal and you can invest 50,000 rupees, you save taxes. Another option is you tell your company, you tell your employer, please deduct, X percentage of my salary or from my basic salary. Maximum limit is 10% of your basic salary. Okay, so you can say to the employer that please contribute 5% of my basic salary and give it to NPS department. So only in the new tax regime, NPS, which is contributed through your organization, only that forms a part of your exemption. If you contribute, let's say if you log into the NPS portal, you put 50,000 rupees, that will not be considered as a tax exemption in the new tax regime. Okay, so only benefit has been given to salaried employee, and again the incentive is the government wants to put, to move them to the new tax regime. Okay, that is the simple reason. So you can contribute via your company into your NPS, to your NPS, and you can transfer comfortably. Let's say you can pay from that bucket. So I think the new and the older one, basic doubts are clear. Now let me just move to the exemption part. We'll have good amount of time for Q&A at the end, 15-20 minutes. I'll take most of the Q&A, so you can keep dropping it in the chat box. Okay. Now let's come to the HRA. So how do we compute HRA? Somebody asked earlier in the question, what is the optimum level of house rent allowance which I can calculate and I can pay rent? Again, I've prepared one calculator. Online calculators are also available. You can just log in your details and you'll be able to find out. First component, from your salary structure, take out basic salary. You have a component called basic salary. Just write it down. Second, you have a component called HRA, house rent allowance. Just write that down. Third component is rent paid. Whatever rent you are paying to your landlord, just write it down in a piece of paper. If you have all these three information, two information you will get from your salary slip, and the third information is available because the rent which you are paying. What you need to do then, if you are in a metro city, what is the definition of metro? Calcutta, Bombay, Delhi, and Madras, Chennai. These are the 4 metro cities. If you are in metro city, calculate 50% of your basic. Otherwise, calculate 40% of your basic salary. Okay, so if I am, let's say, staying in a non-metro city, or let's say I'm staying in Bombay, I will take 50% of 5 lakh, which is 2.5 lakh. First figure you arrive at. Second, HRA as per your salary slip. So whatever HRA component is mentioned in your salary slip, just place below it. Third component is rent paid minus 10% of basic salary. So what is my basic salary? 5 lakh rupees. 10% of 5 lakh rupees is how much? 50,000. So whatever rent I am paying, I'll deduct 50,000, which is 10% of basic salary out of it. The moment I do that, I get these 3 components. First is 50% of basic salary. Bangalore, again, Calcutta, Delhi, Bombay, Madras. These 4 are metro as per income tax. Okay, let's not get confused. As per income tax, these 4 are metro. Bangalore is not metro. Okay, so 50% of your basic salary. Second, HRA as per your salary slip. Third, rent paid minus 10% of basic salary. Once you calculate, you will get this 3 figure. Whichever is the least, your organization will consider it for the HRA purpose. Okay, so in this case, let's suppose the least is 1,90,000, and considering you are in 30% tax bracket, on 1,90,000, 30% you will straight away save taxes. Okay, so assuming considering around 2 lakh with 30%, roughly 55-60,000, you will save taxes. So this is a very important component. Please ensure that if you have somebody whom you can pay rent, but again you are staying in let's say Bangalore, your parents are staying in let's say in a remote location, in a let's say in another city, you can't pay rent to them. That will get rejected by your organization. Okay, you have to find someone in that same city whom you can pay rent and you can save taxes. That that will be considered. So this is something really very important, and this is the way you can calculate your optimum HRA. So you can keep increasing your rent if you want to calculate the optimum until it reaches this 2,50,000 threshold limit. So what is the least out of these three? So you can pay rent slightly more, you can show and pay rent slightly more, and you can come up to that maximum 2.5 lakh limit. So that is the maximum ceiling threshold limit on which you will be able to get income tax exemption for your HRA. Clear? I hope this should be clear to all the calculation part. So 91 lakh 90 is simple, rent paid minus 10% of basic salary. I have written, friends. So what is the rent you are paying? You are paying a rent of 2,50,000. 10% of basic, how much? 50 lakh, 5 lakh pay 10%, 50,000. Rent paid minus 10% of basic. You get this three component, whichever is least out of these three, company will take that as an exemption amount on which you will get HRA exemption. Once you look at your form 16, you will find the same calculation. 50% of your basic HRA and rent paid minus 10% of basic salary, least of these three things, and that will be taken in the above for income tax exemption purpose. Okay, just go through it. Maybe and if you have any query, maybe you can reach out to me later. Then let's talk about old regime. What are the exemptions which are available? Still, why the old regime is good? Considering, let's say, if I'm claiming my HRA, I'm doing ATC investments, I'm doing let's say I have an education loan, I'm investing into national pension scheme, and I have my housing loan also. In that case, even though my salary is more than 25-30 lakhs, still the old tax regime is better for me. Let's say if my HRA is 50,000 per month, 6 lakh rupees I pay as a rent. Just giving you a scenario, even in that case, even if my salary is more than 35-40 lakhs, still the old tax regime turns out to be better for me. So old is still gold for some of you who are claiming HRA, who wants to buy a house, let's say in future, near future, you wanted to get interest exemption, and at the same time you are contributing to NPS, self-contribution plus through employer, both is eligible in the old tax regime. In the new tax regime, only NPS contribution through your organization that is available. Self contribution is not, you're not eligible for that. So let's look at it. What are some of the best products in employee provident fund? And trust me, friends, even if you are in a new tax regime, still employee provident fund is one of the best product in the entire world. No country gives you 8.1% guaranteed tax-free return. This kind of a guaranteed tax-free return you are only getting in India itself. So please, you should invest up to 1.5 lakh rupees every year into this employee provident fund as a part of your allocation into debt product. And once you are doing in ATC, you are in old tax regime, you get the exemption. Okay, there was a slight change which came here. If your contribution to employee provident fund increases beyond 2.5 lakh rupees, then up to 2.5 lakh rupees, you will earn 8.1% tax-free return. Any amount which you have put in employee provident fund beyond 2.5 lakh rupees, that additional contribution, whatever returns you earn will be taxable. Okay, so let's take a simple example. I am, let's say, assuming, let's say some of you are in very high salary bracket, 30 lakhs, 40 lakhs, your employee provident fund, let's say, goes up to 3 lakh rupees per annum. On 2.5 lakhs, you will get 8.1% tax-free return. On 50,000 rupees, which is over and above 2.5 lakh up to 3 lakh rupees, this 8.1% return will be taxable. So some of you friends are voluntarily contributing to employee provident fund, but please ensure that your voluntary contribution should be total less than 2.5 lakh. And this includes only your contribution, not the employer contribution. Don't mix up and confuse the key. I'll add employer plus employee. If employer plus employee is more than 2.5 lakh rupees, then I'm exceeding. No, your contribution, if it exceeds 2.5 lakh rupees, then it's very simple. Any additional contribution, whatever returns you earn will be taxable. Up to 2.5 lakhs, whatever you earn will be tax free. So please ensure, even if you are voluntarily contributing to your employee provident fund, it should not exceed 2.5 lakhs. Okay, Next best product is Sukanya Samriddhi scheme, where if you have a girl child, the age of girl child is less than 10 years and you don't have more than 2 children. In that case, you can invest in Sukanya Samriddhi scheme. You get 7.6% guaranteed tax-free return. Next comes your public provident fund. So sometimes, let's say you wanted to put money into provident fund, but your employee provident fund is more than 2.5 lakh rupees, it is getting exceeded. Then you can invest 1.5 lakh through PPF. Okay, through a public provident fund, you can invest 1.5 lakh rupees. We get 7.1% tax-free return. And another products through which you can save taxes is your national saving certificate and your tax saving FD. But please ensure when you choose these two products, returns are taxable. So if you would ask me what are the best products, employee provident fund, Sukanya Samriddhi, followed by PPF, and some of the products which typically you should not invest is your tax saving FD and national saving certificates, because returns are taxable. Okay. Your ATC also includes your unit insurance premium. You pay insurance for LIC, ULIP plan, term insurance, any kind of life insurance premium which you pay, all gets included under ATC. Okay, your ELSS mutual fund is also a part of ATC, where you invest in mutual funds and typically equity linked savings scheme, which gives you tax advantage. It just has a 3-year lock-in. So many of the people wanted to invest in ELSS primarily because returns are higher and the lock-in is lesser. But again, don't expose yourself everything to equities. Better have employee provident fund, have a mix of ELSS mutual fund, take a term insurance, and create your bucket accordingly in the ATC. Another important component, friends, which gets covered in ATC is your principal repayment of your housing loan. So many a time, some of you have a housing loan. Okay, again, I'll talk about this, slight in a bit elaborative manner. Most of you have housing loan. So when you pay loan, you pay EMI. That EMI has two components. One is principal repayment, another is interest repayment. Okay, once you pay principal repayment, whatever amount you're paying in the year, that gets covered in section 80C. Okay, and the second part is your interest payment. Whatever interest you are paying for your housing loan, that gets covered under section 24, where you get up to additional 2 lakh rupees exemption. So if I'm buying a house, I'm paying an EMI. In that EMI, if my total interest payment is up to 2 lakh rupees, you can get exemption and you don't have to pay tax on this 2 lakh rupees. So it's a huge tax saving for people who wanted to buy a house. Okay. When we talk about this interest on housing loan, normally people have 2-3 very important questions. First important question, assuming let's say you have a house in Bombay, okay, and you have purchased, let's say you are staying in a rented house in Bombay. You are staying in a rented house in Bombay. You have purchased a house in Bangalore. Will you get exemption of both HRA and your principal repayment on your housing loan? Yes. Again, I'll repeat, you are staying in a rented house in Bombay, you have purchased the house in a different city in Bangalore. You will get exemption for both HRA as well as your principal repayment, or let's say your interest on housing loan. You can claim exemption for both. Okay, it has to be house, not land. Okay, you can claim exemption for both. Second, considering you are staying in a Bombay in a rented house, and you have purchased a new house in Bombay itself, okay, in that case your company will reject. They will tell you that you can submit only one claim. Either you can take HRA or you can take interest on housing loan, 2 lakh rupees, the benefit which you get. But friends, what income tax says, again, please listen to this very, very carefully. What income tax says, you can claim both HRA as well as interest on housing loan. You can claim both, even if it is in the same city, provided you prove the genuinity that why you are staying in a rented house, because even though you have a house in your own city. So your company might consider only one, but while filing your income tax return, you can claim both. And if any query come from income tax, you can give any genuine reason that maybe your kid's school is beside your rented house, or the rented house is bigger than what your own house, what you have owned. You can claim exemption for both. This is a very big confusion. because normally, you know, company cannot go to each and every employee and they can see, please give me a genuinity certificate that you are saying this is a genuine reason. And most of us, you know, sometimes, you know, we give false justification that, you know, because of XYZ reason. So company will only consider one. But while filing your income tax return, if your reasons are genuine, you will be able to get exemption for both HRA as well as interest on housing loan. Okay, so I think again this would be a biggest takeaway for all those of you who are staying in a rented house in the same city, plus you have purchased a house and on a loan in the same city. Third question related to housing, you know, it comes into mind. You have booked a house and you will get possession after 4 or 5 years. You are paying a EMI till that period. Whatever EMI you have paid, unless the project is completed, you will not get exemption. Okay, so let's say in this 3 years I have paid 4 lakh as the interest proportion to the bank. What can maximum I do once I get the possession certificate? From that time till next 5 years, whatever interest I have paid during under construction period, I can claim exemption. Okay, that exemption doesn't go waste, friends. Whatever you have paid during under construction period, it doesn't go waste. While filing your income tax return, you can get exemption for that. So please, you know, these are some very, I would say, in-depth, insightful pointers. Please make a note of it that you can get exemption even though you are in the same city, you have a rented house, and let's say if you have paid rent during under construction period, okay, you have paid EMI, sorry, during under construction period, you should not be worried about. When you get the completion certificate, whatever interest you have paid, you can divide in next 5 years and you can pay, you know, in the next successive 5 years, you can pay that. Okay, I hope this point is very clear to all of you regarding the ATC part. Okay, HRA, I would say the house loan and the HRA, combining both the part. Next is your ATCCD NPS, National Pension Scheme. Trust me, friends, those who are in 20-30% tax bracket, you can blindly go for NPS scheme. It's a good option where you invest for a long-term perspective. You get a good return, and you can contribute to NPS via 2 methods. Again, first method is self-contribution, where you can log in and pay 50,000 rupees. Second method is simple. You tell your company that, you know, please deduct X amount of money from my salary. What is the maximum amount? 10% of your basic salary I have written. You can contribute to NPS, no problem at all. However, in the old tax regime, you will get exemption for both these kind of contribution. In the new tax regime, you will get exemption only for which is being contributed through your employer. Just keep that in mind. And it comes with slightly 1 or 2 drawbacks. First drawback is you will not be able to redeem before the age of 60. Okay, once you retire, you will be able to get the money back, but government will give you 60% of the purpose back. Balance 40%, you have to park it in a pension fund and you will keep getting monthly pension of 5-6% return out of it. Okay, so that is the only drawback. In case of any emergency, let's say your kids' education, schooling, or let's say in case somebody is not well, then you can redeem maximum 50% of the amount which has been contributed. But in normal cases, it is very difficult to redeem. Moment you turn 60, you get 60% of the purpose back. Balance 40% has to be parked in a pension fund. Very simple. Okay, so it's a good product. You can look forward to invest in NPS in order to save taxes. Okay, then we have covered ATC. And this ATCCD is over and above ATC. ATC limit is 1.5 lakh. ATCCD limit is 50,000 plus 10% of your basic salary. That is the maximum limit. And then comes your medical ATD. So some of us, most of us are covered by organization through a medical health insurance. Okay, but still I would suggest take a separate health insurance apart from the company, because many a times, you know, we change companies. And when you change company, sometimes there is a break of 2 months, 3 months when you join new company, and that point of time you don't have any health insurance for your family members. Please ensure that you take a small 5 lakh cover so that in case of any such emergencies happen, probably, you know, you have a life cover. And most of the policies, you know, they become active after 3 years. For first 3 years, they will not cover any pre-existing disease, etc. They will not cover it. So please have on your own. So whatever premium you pay, 25,000 rupees up to 25,000, you can cover yourself, spouse and children. If I'm paying for my premium, if I'm paying premium for my parents who are senior citizen, then the limit goes up to 50,000. From 25 to maximum 50K if I'm also paying for my parents who are senior citizen. Okay. Next is 80G. 80G talks about donation. Again, many companies might not consider donation as in their income tax internal portal. Okay. Because they don't know which religious trust, which charitable trust it is there, and for them it is very difficult to prove the genuinity of those trusts. But we can pay donation to any political party, any religious institution, or let's say any charitable institution. You can pay and you can get exemption. The trust gives you an exemption certificate. While filing your income tax return, you can get exemption. Okay. No, these are not available in new tax regime. I'm continuously telling you, in new tax regime, only this part is available, 80 CCD2, where you contribute into NPS through your organization. Apart from that, new tax regime doesn't cover anything. You will not get HRA also in new tax regime. Only 50,000 standard deduction and this 80 CCD2 which you contribute to your employer, only these two parts get covered. Please don't confuse yourself. Okay, it doesn't cover apart from this. So 80D, 80G, 80DD, all are as per the old tax regime. Okay. So 80DDA means whatever interest you earn in your savings bank account up to 10,000 rupees, it is exempted. Beyond 10,000 rupees, you have to pay taxes. Okay. And for senior citizen, it is 50,000. So another hack I am giving it to you. Let's suppose if you are accumulating good amount of money in your savings account, maybe you wanted to buy a house. Don't put your money in your savings account. Better you can shift it to your parents' account. If they are senior citizen, you can transfer money to their account. Whatever interest they will earn, 5-6%, that will be tax free. In your case, the moment interest amount crosses 10,000, the entire amount will be taxable. So please ensure you shift from your account, to their account. That really makes a lot of sense to do that. Okay. Next. Education loan, very, very important. Most of you have, must have education loan. So whatever interest component you pay as a part of EMI, whatever interest you are paying to the bank, entire interest you can claim exemption. Okay, there is no upper limit. If you have paid interest of 3 lakh rupees in a year, you will get exemption for that. Okay, so home loan is a very good loan. Your house loan is a very good loan. But because you get tax benefit, all other loans, whether it is your personal loan, credit card loans, are bad loans. So I would suggest all of you to please avoid, these bad loans. Okay. Next comes interest on housing loan. I've already talked about. Another important clause, electric vehicle. Now most of you are keen to buy electric vehicles. Okay, you are looking forward to some new models, or maybe when the price get reduced, we will go forward in order to buy that. So another important element, in this electric vehicle is you get an interest exemption of 1.5 lakhs. So let's suppose if I've taken a loan and if I'm paying an interest for paying that loan. So whatever interest I'm paying up to 1.5 lakh rupees, I'll get exemption. Okay, I'll get exemption for that. So that is very, very simple. So all this you will be able to get in old tax regime, friends. Okay. Now let's talk about taxation on your equity, SIPs, equity related mutual funds, and cryptocurrencies. Let me first come to crypto. Very interesting. We have to pay flat 30% tax on all profitable trades. And repeat the word once again, profitable trades. Assuming in 1 year you have done 4 transactions in crypto. In one transaction you made 10,000 profit. Another transaction you made 50,000 loss, third profit, fourth loss. Total you have actually made 20,000 loss. If you have made loss in a year in a transaction, you don't have to pay any tax. That should be. But what government is saying, forget about it. In 2 transactions you have made loss, don't calculate. In 2 transactions, whatever profits you have made, pay me 30% tax on these 2 transactions. So imagine I made a loss of 20,000, still I'll pay a tax on this 40,000 rupees, 30%. I'll pay a How much? I'll pay 12,000 rupees tax in spite of making a loss of 20,000 rupees. It's a clear-cut message that government want to discourage investing into crypto, and that is why they have beautifully drafted it. You will be taxable on all profitable trades rather than total profit and loss. They will not take that into account. Okay, so it's really very important for all of us to understand. Okay. Affordable housing scheme I generally skip because again it comes under Pradhan Mantri Awas Yojana, and the eligibility to claim, it has a lot of clauses. It should be your first house, your income should be less than 5 lakh rupees. A lot of exemptions are, a lot of typical clauses are there, and 80% of you might not be eligible to get those that benefit. So that is why I've just skipped that, because I want to take more questions on the other part. Equity plus equity mutual funds. Okay, again, understand in this equity and equity mutual funds, they have the same tax structure. Less than 1 year, you have to pay 15% tax, which is called as a short-term capital gain. Anything more than 1 year, whatever profits you make, 1 lakh rupees, it is exempted. Beyond 1 lakh rupees, you have to pay flat 10% tax. So consider I have made a profit of 3 lakh rupees. On 1 lakh rupees, I don't have to pay any tax. On 2 lakh rupees, I have to pay 10% tax. Very simple. Long-term capital gain, 10% with an exemption of 1 lakh rupees. Short-term capital gain, flat 15% tax. There is no exemption at all. And if I have any loss, that loss I can carry forward for next 7 years and I can adjust against the profit. This is another important element. Most of us, don't realize it. Agar loss hai, we don't carry forward that loss. Let's say in the next successive year, you can do that, and you can adjust with the profits which you will earn in the successive years. So please understand, this is really very important point. And some of you also do some kind of a speculation trade, buying today morning, today evening. Again, it will not fall under short term. These transactions will be clubbed with your income tax. And some of you does futures and options. So futures and option also forms as a part of business income. You will not get any short-term capital gain. Whatever income you earn by selling a call or a put, etc., it will be fully taxable. Okay, as per your income tax slab. So please understand this equity element. It's really important. Now let me just do some permutation combination for all of you. I'm considering this 10 lakh rupees salary, assuming that there is no house rent allowance. Because if there is an HRA, then probably in this case, or probably for the old one you have to reduce the HRA. For the new one, there is no HRA. I'm considering after your HRA, assuming, let's say, if the annual salary is 10 lakh rupees after removing the HRA, and you are doing normal ATC investment of 1.5 lakh, NPS, medical, standard deduction, both the schemes are eligible now, then new tax regime would be better. If after considering your HRA, your income comes up to 10 lakh rupees, in that case, the new tax regime would be better for you. Okay. Again, recompute considering what all exemptions you have. There are numerous exemptions. Like in this case, somebody is earning a salary of 15 lakh rupees after HRA. I've considered HRA. I've not included that. Your ATC, NPS, medical, standard deduction, 2 lakh interest on housing loan. So see, this guy has interest on housing loan. In that case, look at it. The moment we have interest on housing loan, the old tax regime is better. The moment you have HRA component of another 1 lakh, 2 lakh, old would be better. So understand whichever is better, and then you take a call. Again, somebody who is earning 20 lakh rupees, look at example, very simple. You have, let's say, an income. You have deductions, etc. Everything. Sorry, that should be 20 lakh rupees. It's a printing mistake. However, the end result is okay. 17.5 lakh rupees in this case. You do normal ATD. You don't have interest on housing loan. The moment you don't have interest on housing loan, just look at it. The new tax regime is better for you. But just consider HRA also before taking this. Okay. So these are the changes as per the new and the older one. Beyond 15 lakhs, you have to pay 30% tax, and few key changes in the policies which are there. New things which have been introduced. Let's say life insurance policy. Earlier, any income anybody would have earned out of insurance policy were completely tax free. You don't have to pay any taxes. But now what government has said, if an HNI, normally a high net worth individual, sorry, if you pay an insurance premium of more than 5 lakh rupees in a year, so assuming in this particular financial year, my premium is more than 5 lakh rupees going ahead from the next financial year, any new policy I take, whatever returns I'll earn, it will be taxable. So again, it is a way, because any which ways insurance companies don't give you more than 6-7% return. If that becomes taxable, it's a way to discourage, people, or it's a way to tax people who are earning very, very high salary. Another is market linked debentures. These were some of the debentures, again 10 lakh rupees plus bonds. Most of the HNIs used to invest. Earlier it used to attract long-term capital gain of 10%, but now what government has said, you have to pay tax as per the normal bonds and FDs as per your income tax slab. Okay. Third is 54F, capital gain. So let's say if I'm selling a property and I'm getting a capital gain of more than 10 crore rupees, so in that case I'll not be able to set off by any other investments. And fourth is international investing. Some of us have opened our Demat account and we are investing in overseas companies, let's say Apple, Google, Amazon. Earlier the TDS was 5%, now the TDS is 20%. This is again to discourage people to invest outside, because rupee depreciation is there. So these are some of the products and the returns for your investments. But again, these are all as per the applicable for old tax regime. You have PPF, PF. You can still invest, being in a new tax regime, products like PPF, Sukanya Samriddhi, because you're getting a guaranteed return, but you'll not get the tax exemption. Okay, LTCG, STCG we have talked about. So some of the mistakes, and I will talk about the age-wise tax planning. If some of you, let's say, who are in a very young age, around 23 to 30, 35, the best way to invest is through employee provident fund and the combination of SIPs. That is the best way. If you are, let's say, in a salary range of 35 to 45, most of your ATC exemption will get covered by your principal repayment of your housing loan, kids' education fees, tuition fee that you pay. That also gets covered in ATC. So that is the time when you should focus on wealth creation. Okay, diversify your money into different asset class. Don't put all your eggs in one basket. Diversify into, let's say, other products, be it gold, be it mutual funds, be it employee provident fund, be it recurring deposit for your short term. Diversify. And somebody who is above the age of 55, you should not have much allocation to equity, have allocation to debt. Okay. So some of the mistakes people do, first is rushing. Normally throughout the year, most of us don't do anything. When we'll get an email from the company, then we'll rush and we'll try and save something. You end up buying something which may not be aligned to your financial goal. Don't do that. Employee provident fund is better than your PPF. It gives you 1% higher return. Invest there. And again, don't get into the trap of buying these ULIPs and all these kind of a product, because again, they don't give you much of a better returns. The returns are lower. Best combination is your employee provident fund, term insurance, and SIPs, probably from a longer term perspective. Okay.